Hello, everyone, and welcome to the Property Trio for what is our May market update. I'm joined by my two favourite interlocutors, David Johnson and Cate Bakos. How are we?
Good morning, Mr. Mortlock.
Good. I liked being your co-pilot on the weekend, Mike.
Well, unfortunately, we were on the ground, but
We were
no
going
less
at jet speed, though.
no less speedy. That's true. Yep. So Cate snuck into the Hunter Valley in my backyard, and we managed to sync up and have a little slightly boozy lunch, although under 0.05. But
Yeah.
enough banter. We got plenty to get through on this particular one, and there's some really interesting data on the growth rates. Kicking it off with the monthly data from CoreLogic. Again, for the second consecutive month, we're seeing Perth do 2%. It begs the question, how far has Perth got to go? I mean, could it go another 12 months?
Yeah, I reckon it could.
Yeah, I think it's going to have a long tail.
It's been playing catch up for such a long time. And when you look at the disparity between, historically where it should be when contrasted against the Australian property average, Perth's not suggesting that it's at the top of its cycle yet. I know a couple of people will disagree with me, namely Terry Ryder. I've heard him talk about Perth, but I don't think it's over yet. I'm not suggesting that it's about to have a completely wild run, but at 2% a month, I'd say that's a wild run at the moment.
Yeah, I think it actually surprised me when I saw the numbers over the last 10 years of Melbourne's growth being something like 89% and Perth's growth was still only 9 or 10% that I shared on the podcast in the last couple of weeks. So that sort of put things in perspective, doesn't it, over a longer period of time, even though it's had this miraculous run over the last 2 to 3 years.
I think it just shows that the Perth cycle, it might have a pattern. It goes absolutely bananas and then does nothing for a decade. And if people understand that and they're aware of that, then they can get kind of their timing right. But the people that are buying now, it's such a different price point than it was in 2019, 2020. And in our data, where we're analysing where investors are buying across the country, it really only started to ramp up from an investment point of view in 2022. And for me, that was kind of like a little bit late to the party. Ideally, you would have gone in a little bit sooner than that.
Well, yeah, I saw Terry Ryder was commenting that his sort of data was suggesting it was a place to get into about 3 years ago before the run really started. He's saying people who are getting in now are probably 2 to 3 years late. And I'm pretty sure, a couple of us on the podcast in our predictions predicted it to outperform, but we're about a year or too early. But, all the signals were there. It had been held back. It had been the poorest performer during COVID. And obviously it had the state border that people couldn't get into back to Perth. So there was going to be a flurry of investor activity once, WA opened up again, and that's proven to be the case. But it's probably the level of it's probably surprised most of us.
It's interesting, Mike, that you talk about it's cyclic performance and this crazy run and then flatline, because the same can be said for the Hobart market. I've been watching that with a keen interest because I have an interest in Hobart, but in terms of property, but they've got two very different drivers, and I think it's interesting to say that there's a pattern to Perth, because I think we've really got to look at what's coming up out of the ground and see whether there's a pattern there.
Yeah, the correlation.
Yeah. Yes, and I mean the real reason why we hit a budget surplus, other than lower than predicted unemployment, was really the resource pricing that was put in the budget estimates was about half of what it actually ended up being as at May. So yeah, interesting that there is that correlation between resource prices and the market movement in Perth, but not to be outdone. Adelaide and Brisbane not that far behind, 1.8% growth for the month for Adelaide, and Brisbane at 1.4. That's not a million miles away.
Adelaide is like the star child in all of this, in my opinion. And interestingly, when you look at the parity chart where they're all benchmarked against the Australian average, it could be argued that Adelaide's the most overcooked, but my goodness, it doesn't look like it's running out of legs yet.
It doesn't, does it? But it does feel like Adelaide's overcooked, and it's just hard to see where it has that ongoing economic drivers to be at this sort of level in terms of, big picture, macro picture, median value prices. But it's certainly surprised me that Adelaide stayed so strong for this extended period of time.
So let's talk about median values, because the deck has been reshuffling seemingly on a monthly basis. I can recall, not that long ago having an interview where I said, look, Perth's got some great fundamentals because it's the second lowest median outside of Darwin, and no one invests in Darwin because it's just too crazy to predict. But Perth scalloped along, and we've seen a little bit of a changing of the guard. What have you observed, Dave?
Yeah, so Brisbane just keeps flying, and it's overtaken Canberra as the second highest median value across the capitals in May. So this is a position that Brisbane hasn't recorded since 1997. So this hasn't happened for a long time, where the Sandgrove, not the Sandgrove, that's the Western Australians, isn't it? But those what is it? North of the Tweed, is that the saying?
This is your joke, Dave.
I've got no idea.
No.
So anyway, the Queenslanders haven't been in this position, and Brisbane hasn't been in this position for 27 years. And look, it's actually, has a higher median house value than Melbourne, which for the first time since 2008. So a good 16 years ago. So look, it's really, part of the story is obviously Melbourne's underperformance, as well as Brisbane's outperformance here. But the big question always is this an ongoing long-term trend? I mean, history would suggest it's not. History would suggest occasionally Brisbane pops its head up above the parapet and ahead of Melbourne, and then people start to see that it's a bit, bit expensive to get into the market there, and money starts to come back into the Melbourne property market. But we'll see if this time follows on the historical pathway.
Yeah, interesting you talk about Melbourne. I shared some data on a previous show and in the paper recently about the number of new investors coming in from an ABS lending point of view and the number of rental properties that are for sale. Cate was on the telly on the weekend talking about Victoria, and it does sort of seem artificially dampened by policy. But, we're talking about doom and gloom for Victoria, but I'm seeing so many green shoots.
Yeah, I agree. I think we talk about it most months, don't we? But I think something that I've come to realize, particularly doing this podcast, is often you can see the green shoots and they don't come through for up to a year, can be even longer following it. So it's, you need to be a bit careful with that.
Steady on, Dave. It did do 0.1% in May. And I mean, if that's not a stellar performance, I don't know what is.
I want to talk about what is a stellar performance soon, and there's some data about new listing activity that supports the fact that for Melbourne to deliver any form of positive growth, granted it's the smallest amount of growth that we could have seen registered, 0.1, but considering the listing volume, it's a pretty impressive score. So we'll chat about that when we get to listings.
Yeah, let's move quickly on to rents. One thing that is very, very surprising to me is the resilience of rental growth in Perth, given investors have piled in en masse. The annual change in rents for houses in Perth, 13.5%, but it's dipping from a unit point of view down to, isn't that a weird thing to say? It's down to only 14.7% growth in units. Do you think that's maybe investors are buying more the townhouse and the villa style units? Because certainly Perth is not really a high rise market. It kind of defies logic to me. There's been so much rental supply going in, but it's, even the vacancy rates are tighter than the national average. What's your read on that?
Well, I think we have to think about, what the locals are buying for themselves as owner occupiers as well, because there's been a bit of a run on there for them. We've seen employment tick up for the resources sector, and obviously got a lot of people circling that. So they might have had Perth, for example, might have had more fly in, fly out going to other sites, and now you've got people that are purchasing in their own city. But dare I say it, you're saying it's ticked down, but at 14.7%, that's still a really strong, tight vacancy rate, strong demand, Mike, by anyone's measure.
It's ridiculous. It's absolutely ridiculous, isn't it?
Yeah.
Yeah.
And then we've seen a bounce off the bottom from Hobart and Canberra, but still only 1.3% increase in Hobart. But I think it's important to remember that Hobart had quite a run, didn't it? We were talking about it before, that Hobart mimics WA in some respects, completely different drivers, but it tends to be very, very dormant. And then you bought in Hobart. What would that have been? 2000, 2001, or maybe it was actually pre-pandemic. It started to kick, and then of course it continued. You would have done tremendously well.
Yeah, look, Hobart's an interesting market, and I've got a couple of properties in Hobart, so I'll chat about what's impacted rents there. During lockdown, when we had border closure, we were allowed to fly around Australia, but getting overseas was a little harder. We had a lot of landlords down there turn to Airbnb. So the rental market was decimated because all of these properties were then short stays. And we've seen a few of those come back onto the normal rental market now that everyone can pick wherever they want to go to around the globe. So, it's a very different market to some of these other cities that we're circling. And that's why one key reason why rentals had a hard time. But likewise, a lot of people bought down there for the big tree change, sea change during lockdown as well. And they've returned to the mainland.
Yeah. Look, the macro picture is we are seeing rental growth continue to slow again. So that's a number of months in a row now. So it's still high at a 0.8% for the month. And so that has grown at 8.5% over the last 12 months. The previous 12 months was 8.9%. And the 2 years ago was 9.3%. So it's still quite high, but we are seeing a gradual decline in the monthly rents on a big picture at the moment. Now that might be, as part of that might be the bulge of dwellings associated with the home builder scheme transitions coming to completion. So, logically we should see homeowners moving out of their rental accommodation into their newly built homes. And so that could be part of the picture that's playing out there. Obviously, migration numbers are being stalled as well at the moment. So it'll be interesting to see if we can, you don't think this can go on forever. So, I mean, obviously vacancy rates are still at historical lows, but we are just seeing a gradual tick down in the rental growth over the last sort of 4 or 5, 6 months.
The rate of growth, that's the thing. We're still looking at really strong growth numbers. Like even Melbourne, you can see that houses have come off a little bit, but even now houses are at 9.7. What am I saying? Yeah, Melbourne, 9.7%. That's nearly 10% growth year on year. That's really hard.
But if we sprinkle it with a bit of perspective, like over the 5 years prior to COVID, the national rental index was rising at an average annual pace of just 1.3%. So there's actually a fair bit of catching up to do as well.
Yeah, we're up 8.5% over the past 12 months, which is down from 8.9% 12 months prior and 9.3% 2 years ago. So we've had a hell of a catch up. It'd be interesting to get back to Mr. Kalizos, who charted rental growth and inflation and found that inflation won over that decade period. I wonder when that crossover point is. I will be in his backyard later this week, but unfortunately he's interstate, so that is a missed opportunity. But we'll see if we can get hold of him. Let's talk about the yields. Obviously, when prices increase and rents stay stagnant, the yields decrease, but we've seen such strong increase in rents that it can sort of seem to stomach capital growth and still be up there. Combined regionals gross rental yields at 4.4% and combined capitals at 3.6%. Now, typically we always see the regionals do better, but with the combined capitals, I mean, 3.6, that's fairly solid, right?
It is. The hardest thing about this, though, it's like that median property price data that Dave has spoken about before for cities that have differing ratios of houses and units. And it makes it really hard because if you get a capital city like Melbourne with a lot of high rise and smaller units, of course your rental yields are higher on those. So it's a bit harder to distill. And I actually would have loved it if CoreLogic captured this for houses only, because I think that would tell a more accurate story.
Yeah,
it would be useful.
You've got Melbourne at 3.6% and Brisbane at 3.8%, and Melbourne's more famously a high-rise city than Brisbane is, but still across the board, even Sydney at 3.1%. I mean that's higher than I'm normally ever used to seeing. I think that feeds fairly well into vacancy rates. The print for March 2024 was 1%, up from 1.2%. Actually, it was up from down from 1.1% in the previous month. But again, as I referenced before, Perth at 0.5%, Adelaide at 0.5%. That's a good indicator as to why I think Adelaide is performing so well in concert with Perth, and Brisbane, of course, 1%. I mean, that's still, those are the three tightest, and the worst performer at Canberra at 1.6. That's still crisis levels of rental vacancies, right?
Yeah. Well, look, they were the March numbers, and if you look at the April numbers, they've just. Sorry, Mike.
That would help.
It's shaded in blue, Mike.
they've just ticked up slightly, but still so tight, aren't they? 0.5 for Perth and Adelaide's gone to 0.6. Vacancy rate, Hobart 1.3 to 1.4, Canberra 1.6 to 1.7. I mean, that's negligible, isn't it? It's 0.1% increase.
For the southern cities, interestingly, you'll see less tenant movement, and the take-up rate and the demand is always a bit more subdued as the weather starts to get a little bit cooler. And you notice that. I usually say to my clients when we're settling an investment property, let's try and get you settled ideally in May. We can, in this tight climate, we can certainly do the winter months, but if you're in a climate where you haven't got such high rental demand from tenants and such tight vacancy rates, you'd ideally avoid the winter months in the cooler climate cities.
Now, speaking of months, Cate, there used to be a thing called the spring selling season. Now, it seems to have gone into a hibernation over the last couple of years, but it seems like maybe it could have a little renaissance once we get through this winter chill. What are the listings doing?
Look, we're being a little bit unfair suggesting that the spring selling season isn't still there, because the 5-year previous average is taking into account COVID. And that was an insane time for everyone, and for some cities in particular. So if we have a look at the 2022 figure, you can see that sort of dipped in spring. And I remember spring 2022 was a very weird time. We actually had more volumes in winter. But it looks like it's tracking kind of normally. We've had that uplift at the start of the year. And in fact, this year we had more new listings in the autumn season than we've had in a long time. And we're on track. But what this is showing me is new listings are sitting just above the 5-year average at the moment. So that says to me, nationally, we're enjoying more listings than we're typically getting at this time of year. But when we have a look at total listings, it's under all of the previous years. So when people are saying to me, there's no stock, there is indeed much less stock. We've got less stock on the market now than we've had in the last 5 years at this point in time. But new listings are higher. So what that says is the buyer take-up for all of this is really strong. We're seeing, a lot of people pouncing onto new listings. And as CoreLogic said, at the national level, total stock for sale over the 4 weeks, despite new listings tracking above average, overall listing levels have remained fairly subdued due to a strong rate of absorption from sales.
That's
so
the
we
thing,
can say
isn't it?
we like, we've got higher interest rates and people are saying that lending's tough. We've got a lot of buyer activity and it's outpacing supply.
Yeah.
It's just gobbling it straight up. And that's why we can't really necessarily feel it if we're out there on the hunt. Things are getting wrapped up pretty quick. I wonder, anecdotally, from your side of the I was going to say your side of the pond, but from Victoria, are you seeing a lot of off-market activity? Is it higher than in general?
See, off markets ain't what they used to be. They used to be agents reaching out to us when they've got, a genuine situation where a vendor has to sell probably quickly or with particular quirks. These days, we're seeing off markets are predominantly vendors who don't want to pay for the marketing fees because they know that either their property is compromised or they know that their price expectation is too high, or a bit of both. You do get the small off markets, the small number that are great, but we have to distill a lot of rubbish to get to the good stuff. So yes, there are off markets, but a not real off market is when the agent has a database of 200 consumers that they're texting saying we've got this hot off market. That's just a vendor who doesn't want to pay for advertising.
Or a vendor who says, if you get this price, I'll sell it.
Yeah, exactly. And we've got a lot of new players in the industry that are saying they're buyers agents, and they tend to use that off-market magnet to try and sign up clients, and so they're the ones that are getting really excited about these off markets and pouncing onto the text messages. An off-market really needs to be something that you've targeted that's completely suitable to your client, and you've got a genuine situation where the price is fair or it's attractive to a buyer, not a price that's lofty and optimistic on the vendor's part. And there's a genuine motivation to sell, off market. There's a reason why they don't want to take it to market, not just because they don't want to pay for a listing.
Yeah, those are some really good insights. I want to stick with listings for a moment because there are some wild numbers when it comes to percentage yearly change of property listings per capital cities. I mean, the pendulum's swinging so violently. Sydney's up 21%, Melbourne up 27%, Perth down 23%, Canberra up 35%, even Hobart up 16%. Such a tale of 8 cities. I don't know if I've counted that well, but that was a Charles Dickens reference for anyone playing at home. What do we make of that? And what are the indicators in terms of the new listings that's coming onto the market? Is this a rich hunting ground for people that are wanting to see an upcoming trend in property prices, do we think?
Look, I think it often can be. I mean, one of the things that it tends to reflect what's happening in capital growth. So if you look at total property listings, the weakest performing cities have the highest number of total property listings. So Sydney yearly change 21%, Melbourne yearly change 27%, Canberra yearly change 35%, Hobart yearly change 18%. 4 of the weakest performing capital cities. Contrast that with the strongest capital cities, Perth in particular, total property listings are down 23%. So, which really magnifies what's happening there. What I do see is interesting, for example, then is in the new listing numbers. It has a similar sort of spread, except for Brisbane. So Brisbane, we're seeing a jump with 31% of increase of new listings. So that could be a telltale sign that Brisbane is starting to hit a peak. A lot of people are seeing value, seeing it as an opportunity to put their properties on the market. And so that's something I'd be keeping an eye out for.
Using that same methodology, Dave, we've got Hobart with a 16.7% yearly change, but negative 6.5% in the last 30 days. Is that potentially predicting the bottom for that market?
Yeah, look, it very much could be. And we're starting to see that a little bit, aren't we, in the actual numbers for Hobart, where it has been going backwards for a long period of time. And now we're just starting to see some positive numbers for Hobart. So we have talked about it before, haven't we, Kate, at different times in the market updates, that correlation between listings and what's happening with values?
We have, but I think there's one chart we haven't talked about here. And when you look at all three together collectively, you start to get the story. So Hobart has a growing number of old listings. So what that's saying to me is there's a bunch of properties hanging about on the internet on page whatever, 50, and probably not, because there's not that much stock down there. We're talking about a small city, but I'm exaggerating. There's a lot of stock hanging around that hasn't moved. Old listings are greater than 180 days, and Hobart's figure is almost at 40% increase in that number of listings. Yeah. That says to me we've got vendors who aren't motivated or who are greedy or both. So they might be holding out to recoup their like to save on their losses, recoup their price and sell for a certain amount. And they're not motivated because they're sitting there for more than 6 months. A motivated vendor doesn't sit on the market for that long. So that's a really interesting one to me.
It is, isn't it?
Yeah. When we look at the old listings, what gives me a little bit of comfort as well, we can see that, Brisbane, Perth, Adelaide, the trio that have just been smashing it for the last few years, they've got a huge decrease in old listings. So that means that the market's been flooded with buyers and people have grabbed anything and everything, including the low-hanging fruit.
A lot of very happy real estate agents and buyers agents over there. Old listings down 56%. They're selling everything.
Like Sydney's showing a decrease as well. It's more modest at 4.5. But what that's saying is that there's a lot of uptake in these markets. They're the three that are showing red figures. Now, when we look at Melbourne is 0.1%. So what that says to me is Melbourne's old listings aren't growing. It's been static. So it's not as in the doldrums as people would have us think. And then the ones that obviously have had the growth aside from Hobart are Canberra and Darwin. So old listings tell a really good story, because when they float about and when the numbers increase, that's showing an interesting sign that there's a growing pool of stock in that old listings.
That combination, isn't it?
Yeah.
Total listings, new listings, and old listings. Looking at that overall picture tells a really good story.
It does. I think the old listings in Hobart at 39.3% kind of smashes my thesis of maybe it's the bottom with, negative 6.5% of new listings, because there is still a backlog. And Cate, I can remember I might have been one of your Sunday blogs where you talked about old listings, and like it does make me worry about Brisbane, Perth and Adelaide, where the percentage of old listings is disappearing. It's because people are buying those houses traditionally that aren't very marketable, like on the main roads or just in locations where it's a little bit sketchy. And I always worry about the consumer when I see numbers like that. What's your read on it?
Yeah, me too. Me too. A hot market's a dangerous market. I've got clients that are saying, well, should we wait? I'm like, wait for what? Till the market's hot and there's FOMO. It's classic FOMO when you see old stock figures dropping like this, because it means that people they're applying less scrutiny and grabbing whatever's left.
Yeah, it does make you think, doesn't it, about interstate buyers buying sight unseen and not doing the proper due diligence in those three capital cities in particular.
It's like when avocados are on special and everyone buys them at the supermarket, and you get there too late on a Sunday and there's only like 3 left in the bin, and you're just thinking, but I really need an avocado. So you grab whatever, the one that's been squished a few times, and you have to cut the brown out. Like, that's the issue that we're facing in these markets with reduced stock and old listing numbers deteriorating like that.
Yes, be careful with your avocados, people listening. That some of them have been fairly squished. Now let's take the pulse of the nation, a la the Consumer Sentiment Westpac Melbourne Institute. Long run average of 100.6% in May. We're at 82.2%. So down marginally, but up 4.1% over the year. We are still a bit pessimistic about most things, right? Except house price expectations. That is up 11.7% over the year. But the time to buy a dwelling, again, there's such a contrast there. It's like houses are going to go through the roof. Is now the time to buy? Well, no, because we can't afford it.
Yeah. Exactly.
Yeah, lots of people are buying properties. The absorption rate's really high, and the number of listings is above the 5-year average, and they're all being bought. So, yeah, but obviously the people who aren't buying just think, we need to wait, even though they think that prices are going to keep flying. So it doesn't really make sense, does it?
Not at all. It's a little bit of a boring chart, and we said that about the last one.
Yeah.
But boring is good. In this climate, we really want to see boring, because we've had interest rates applied to slow down discretionary spending. We're not wanting to have people panic. We're not wanting to, see signs of a recession. But likewise, we're not ready for, a sentiment bounce back yet, because if we did have that, it would defy what the RBA are trying to achieve, and that is to slow down spending and to get a grip on inflation. I'm very comforted to see that the toys index is still slightly trickling down. It's nothing dramatic, but what it's saying is that household expenditure has been reined in a little bit. And the big ones, if we look at annual trends, is people's thoughts around family finances for the next 12 months. We've seen a pretty reasonable shift there when we contrast it to a year ago, 12% increase. So people are feeling a bit more optimistic about their finances. But the big one is interest rate expectations index is down 24.5% for the last year. So that's suggesting that people think that, things are not going to get better with the interest rate.
Yes, and I see in the news as recent as this morning that banks are basically saying no rate cuts this year. Aren't they such giving characters, the big four?
They just can't make up their mind, though, because when we talked to them late last year, they had a very different perspective.
Well, yeah, they're just following the data, aren't they? I mean, the money markets are now out to next year for the first rate reduction, so they've gotten on board with that.
Let's not forget, this is brought to you by the same people that said property prices would drop 30% during the global pandemic. So that's good to keep it in perspective of their skills as yeah. Oh no, not just Westpac, all of them. They can all go and jam it collectively. Let's talk about something a little bit more positive, and that's the lending indicators. Dave, we've seen some pretty strong numbers here, even though it is a difficult climate. And of course, the outlier of that is construction, which is absolutely ruined.
Yeah. So look, we are seeing pretty strong numbers with owner-occupier lending numbers growing by 4.3%, investor numbers up by 5.6%, and investors up by 36% for the year.
That's a big one, isn't it?
That's a big one.
The year of the return of investors.
It is. It was off a low base last year, but still, it's significantly higher than owner occupiers at 18% over the 12-month period. So, yeah, we certainly are seeing, and that's flowing through, as we talked about, in terms of the number of, another chart I have with the total number of purchases is the highest it's been since November 23. And that the next highest period was May 23 and then back to August 22. So it was the highest month of purchases, the fourth highest month of purchases in almost 2 years for April. So people are making property decisions, that's for sure. And I guess that's they're saying, okay, rates may not be about to come down as quickly as we thought, but we're at the top of the market. And so, look, if I can afford to buy now, it's probably only going to get better moving forward when rates do come down. I mean, there's still a possibility they could increase. But so I think people are feeling like, well, if I'm going to make a move, I should make it now. And, if you look at the consumer sentiment, most people are thinking prices are going to keep going up. So therefore, people are making decisions to purchase.
Now, Cate, you've circled a little graphy here talking about purchase types and the values, and the clear standout is a really big uptick in the purchase of existing dwellings.
Yeah. Why would we be buying existing dwellings and not new?
Well, I have a thesis, and it's born in our data as well. And as the resident sort of construction bloke, I think the clue is just in that definition. It's so bloody hard to get trades. Construction costs are still high, even though they're moderating, and the appetite for fixer-upper style things has been on the decline. Actually, really over from our data over the last 4 or 5 years. It's just so difficult. You don't hear people talking about, renovate to sell style flippy things, anymore, because it's just so difficult to get economically work done to a property.
Yeah, so true. And people's appetite for buying land and holding it is reduced because interest rates are high. So it's not just new versus established that people buy, it's also land. So we've really seen, the construction sector has been so hard hit, and people, even when I'm watching that ease somewhat, people are still a bit scarred by the stories they've heard or the experiences that they've had. I think it will take a while for consumers to have an appetite to buy a renovator or to purchase land and commit. So we've seen a really strong uptick, and so much so, in terms of billions borrowed, it's eclipsing everything on this chart that goes back almost 20 years, except for that crazy, ridiculous run that we had during COVID when everyone was buying property.
Yeah, if you take that blip out, it's still a solid uptrend all the way sort of back from 2020.
Yeah, and it correlates with increasing interest rates. It's quite strange.
Dave, money markets, you referenced them before. We saw a little bit of a blip in and around the budget, which is to be expected, where everyone kind of bets on, how likely it is for all of these predictions to come true. But materially, what are we looking at?
Well, look, I mean, we're so over the three-year bond yield, we're looking at 3.99, so about 4%. So the markets are betting over the next 3 years on average will be 1 to 2 rate reductions beneath where we are today. But interestingly, over 10 years, they're expecting pretty much sitting right where we're at today. So they're expecting the long-term average of rates to be where we are today, 4.3. We're 4.35 with the RBA. The 10-year money market has it at 4.36. So for those who are hoping that, the level of where we're sitting with interest rates is sort of a cyclical high and we'll get back down to quite lower rates, the markets are certainly not expecting that to be the case, and the level we're at today is more likely to be the new ongoing norm, which is in line with what it had been historically prior to the last sort of 5 years, really.
Let's talk unemployment. Basically flat from March to April, no change. Up from the low point, which I think is 3.9%, we're still sitting at 4%. I've been sort of conditioned to think anything under 5% is actually quite low. And, low unemployment is actually a sort of a problem for the country structurally. We need the capacity to grow and to fill these employment opportunities. I think that's what Tim Gurner was trying to say, but said it in a much more inflammatory way. We need more unemployed people, which he needs to talk to his PR people. But we're still in a very, very tight market, despite a huge increase in international migration.
Yeah, and I think this is the thread, the small, what is it? The small thread, the needle and thread that the RBA is trying to. What's that? What's the saying? The small. the needle the RBA is trying to thread with their approach to interest rates is, and actually I think it's Andrew Hauser, who's the Deputy Governor, has come out in the last week and said, look, we're actually going to be a bit more conservative with rates and being a bit more patient with inflation, and where historically they might have raised rates even again already to bring down inflation faster, they're really trying to keep unemployment at the level it's at, which are these historical lows, and trying to have inflation come down without having to push up the unemployment rate, which has been, I guess, has copped it. Yeah, so unemployment, you'll have to cut obviously a bit there, Jamie.
No, we've got to keep that.
Unemployment's often been the collateral damage, as the RBA has been increasing rates to bring down inflation faster. But at this time, they're taking a slightly different tact, and they've actually said that, which some economists are arguing against. But that's what they're trying to keep unemployment this low, without whilst keeping hoping inflation continues to fall back into the target band.
And if you look at our wages, of course, we had a 25-year high in wages growth up until very recently. A tiny little down blip. I don't know if that's a representation of 0.1.
I couldn't call a data shift yet. There, it's one data point.
The trend line's still galloping away, isn't it?
Yeah. We need that dip for a few months, don't we?
Yeah. No, it is interesting to observe the commentary from the RBA, and there's a whole cottage industry of people that read the minutes and they're control Fing for keywords and trying to feel sentiment from it. Clearly,
It takes one to know one, Mike Mortlock.
Yeah. But they are in a hurry to get it back, but not to the detriment of unemployment. Dave, talk to us about the GDP figures. How does that relate to the consumer index of economic performance? What can we expect over the next little while?
Well, one thing we know is GDP is growing quite slowly, and that has the potential to put us into a recession. And it's another argument some economists are making for why rates shouldn't increase. And as you said, there is a cottage industry, and the economists love to have their different perspectives, and it's sort of like there are economists who barrack for different ways of thinking about things and are on different teams, and it's so interesting to watch. But if it wasn't for our migration numbers, we would be in a recession, and we are in a per capita recession, essentially. So our standard of living is going backwards per capita. So these GDP numbers aren't great, but they're a reason why rates are less likely to go up as well. And the underlying thing we need to see an increase in is productivity.
Yes, and we've been talking about that for a long time. And I can remember when OpenAI was kicking off, jumping up and down saying this is going to be a productivity revolution to rival or to surpass the Industrial Revolution. It's a bit like Cate's Victorian predictions. I know it to be true fundamentally in my heart of hearts, but gosh, I wish the data would bloody catch up and make me look like a genius.
Yeah, I think that one might even take more years to play out than us predicting a capital city outperforming, and that comes about 1 to 2 years. I think the AI might take 3 to 5 years before it really starts to flow through. But I think the problem is there might be other side effects that we're not aware of that could happen as well, whether that's job losses or who knows with AI, but we shall see.
I want to chuck in a couple of little data points that I've grabbed from the ABS, which is a little bit lagged to what we're used to talking about with core logic, but wanted to get your thoughts on this. So the total value of residential dwellings in Australia rose by 200 billion in the March quarter. So we're actually now looking at a $10.7 trillion property market, which is actually 3 times the size of the share market. On the other side of the equation, of course, property prices are rising, but the number of residential dwellings rose by 52,700 in the March quarter. And if you annualize that, we're talking about 210,800 being built per year. Of course, that's higher than previous years where we were looking at 1,500 and 1,700. but for demand to match supply, there's a shortfall of around about 30,000. So it does sort of seem like we might be starting to see a bit of an uptick. And Tim Lawless from CoreLogic has said, well, look, supply will likely catch up, but it's probably 12 to 18 months before we start seeing any market cooling. Just in closing, I want to get your thoughts on that. When will we actually see a little bit of a balance? Because we know everything we know about economics is that we can't stay out of balance for too long.
Yeah, look, there's a cross-section of things, Mark, that need to change for new dwellings to tick up. And it's not just build costs, it's also, red tape, council planning, activity and approvals. And when it comes to residential and domestic works to existing dwellings, that takes a sentiment shift from owners as well. So by the time we realise that the builders and tradespeople have got a bit more capacity, it's usually when they're probably starting to feel a panic. I've just lately started having people knock on the door again, giving me flyers and business cards and introducing themselves because they'd like a little bit of work. Builders are out there saying, I can see the light at the end of the tunnel now in terms of being able to service new clients and prospect and get their pipelines continuing. I've already noticed that. I started to notice it about a year ago. But we've also got a lot of civil infrastructure projects that have taken tradespeople away from domestic building projects. Now, as they start to finalise, and also for anyone that's close to all of this or knows someone who's working in construction and employed by a government project, we've also seen a few have their plans reduced and had people's contracts not renewed and cancellations, and that's been interesting to see as well. So I think in tandem it will all start to become very apparent very quickly, but it always takes a little bit of time for that ship to start to steer in a different direction, as we all know.
This is a left field observation, but I promise it's relevant. Every single newspaper I've picked up in the last little while has talked about tradies on cocaine. Now, the angle that they're getting at that is that typically cocaine was, I guess it's an expensive drug. It's sort of something that you see stockbrokers and accountants and financial planners and those sorts of people, the white collar workers, it's their drug of choice. But apparently the sands have shifted to the point where tradies are now the number one consumer of that sort of product. And that speaks to their wages growth, where, there was a story about a guy who's on 200 grand a year, and they're like, yeah, most people, more people than not, are getting up to those sorts of malarkeys on the weekend. And I mean, that's a reasonable indicator that there is, just such a shortage of construction labor.
Yeah, absolutely.
Yeah. Well, that shortage of the labor is a big issue. Was the question about when we think supply will reach demand?
Yeah.
Look, I suspect that when supply starts reaching demand in the next, let's say, 1 to 3 years, rates will be starting to fall. So we won't necessarily see a softening in property markets generally once that occurs. I think at macro picture, it'll be business as usual for the property market with steady capital growth. I think, if anything, the Victorian government has shown the template of, if you want to be a government and slow down property growth, increase land taxes and tax people's second properties. And that's going to slow down investing. It's going to slow down interstate investors. It's going to cause people to sell their second properties because of the high annual taxes. And, also don't run your state that well and have lots of debt. Throw that into the mix, and there you have it. That's how you slow down.
I can just see a journalist quoting you on that, Dave. Well,
I think sadly they have shown every other state government the template. Frankly, I'm a bit surprised if they really want to slow down property price growth, they haven't actually started to follow suit.
Now it's time for our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
For those out there who are looking at selecting a capital city to invest in, and they're wanting to get some immediate growth and they're trying to time the market. It's not necessarily the way that we recommend people target things, but plenty of people would love to see that immediate uplift. I think you've got to look at a lot of moving parts and consider a really broad picture before you circle in on something that's doing well. And as we mentioned during this episode, we looked at old listings, and I think they tell a really interesting story. So if you can get your hand on the rate of change of old listing numbers in a given city and try and distill them so that you can work out whether there's a risk that people are purchasing properties, like I mentioned with the avocado analogy, you might have to have a second look at some other metrics before you dive in.
I love it. Dave?
Look, I'm going to go back to the old tried and true. I mean, market update's all about talking about the market gyrations and, what's happened in the previous month and months and what do we think is going to happen in the upcoming months. But really, it's the big picture and the long term that matters and what's right for your personal circumstances. So, and I think that stat of Melbourne over the last 10 years has grown at whatever it was, 89%, and Perth 9 or 10% helps put that in perspective, as do lots of other bigger picture numbers. So, understand your own strategy, understand the price point that's right for you, select a quality asset, and, as long as it's in a city that has good capital growth drivers over the long term, you're going to do well.
I love that. I've got nothing really more to add other than if you are a tradie, get rid of the Peruvian marching powder and invest in property because it's all going up.
A bit like the Peruvian marching powder.
Yeah, that's a whole nother episode.
Up the nose.
Thank you, guys. We'll see you next week.
See you next week.
See you later.